The number one question we're asked about tactical investing is, why now? Why is it so important for me to understand this approach to investing now? I will attempt to answer that with the following illustrations. When you examine a chart of the US stock market over the past 100 years, it shows an undeniable pattern, a rising market over time. Here's a chart of the Dow Jones Industrial Average over the past 124 years from Guggenheim Investments. If an investor were to glance at this chart quickly, they might be tempted to ask, what's wrong with using a buy and hold approach to investing if the markets always increase over time? Why should we consider tactical strategies? The answer can be found by examining this chart more closely. The gray periods for this index represent longer-term bull markets that historically have ranged between 5 and 17 years, while the purple periods represent longer-term bear markets that historically have ranged between 11 and 25 years. So instead of thinking of the markets as one long-term rising cycle, it would be more useful to think of it as a series of smaller cycles that invariably rotate back and forth, i.e. bull markets are followed by bear markets, which are again followed by bull markets, and so on. Why this matters to millions of investors right now is because approximately 85 million baby boomers across North America, those born between 1946 and 1964, have already entered retirement and are preparing for a long and active lifestyle during their retirement years. But how would someone's retirement be affected if they retired at the start of a long-term bull market versus the start of a long-term bear market? For this group, time may no longer be on their side to recover from a severe market decline. This is not about trying to perfectly time these bull and bear market cycles, but rather understanding which strategies are better suited to each cycle. According to this chart, we're in the 10th year of this current bull market. While a buy and hold strategy would be well suited if this bull market cycle persists for another 10 years, it would be severely challenged if a bear market were to unfold. Based on this, how do you determine which strategy to use given there are valid arguments for both the continuation of this bull market or the start of the next bear market cycle? This is where a true tactical approach provides an alternative to having to forecast these cycles. Our equity mandates with its tactical range of 0 to 100% were designed with the flexibility to be 100% allocated to equities if the bull market persists, or 100% allocated to fixed income if a bear market emerges. It's a two-way strategy that was designed to adapt to either cycle and be a complement to other strategies such as buy and hold in your overall portfolio. The reason why it will become vitally important to manage risk for baby boomers in retirement is because of one key factor that was not a consideration before retirement for most investors, and that is the sequence of returns when entering the withdrawal phase of your investing life. To illustrate this point, the following two charts created by Jackson National demonstrate that during retirement, the sequence of investment returns can have a significant impact on a retiree's account, especially if withdrawals are factored in. This first illustration, showing the sequence of returns before retirement when there are no withdrawals taken, has no effect on the ending value after 25 years. Investor A, the top line, starts with positive returns and ends with negative returns, while Investor B, the bottom line, just inverts the rates of return, so it starts with negative returns and ends with positive returns. At the end of 25 years, both these return sequences achieve an average annual rate of return of 8% and a volatility of 14.4%. The next illustration uses the same inverted return sequence for both investors, but includes a 5% withdrawal at the end of each year. The starting point is the same for both accounts, but the end results are very different. Investor A, the top line, began withdrawals in a rising market, and after 25 years achieved an ending balance greater than when they started. Investor B, the bottom line, taking the same 5% withdrawal each year, starts this process in a falling market, and as a result completely depletes their investment account by year 13. Reducing the impact of negative returns early in an investor's withdrawal phase could potentially extend the life of their investment account in retirement. If baby boomers are indeed entering retirement expecting their best years are still to come, this is a potential obstacle investors and their advisors need to understand and overcome. Why true tactical? Because in retirement, risk management is not a luxury, but a necessity.